everyone, my name is Analia Tan, co-founder and CEO of Kiro.id, a tech platform that helps kids to reach their maximum potential. And welcome to International Speaker Series webinar. This webinar will be held weekly with several topics around marketing, finance, business, and technology. Today, I'm so happy to be here to meet you all and also moderate this webinar session because we have a really good speaker today. But before I introduce him, I would like to explain about this webinar and how it will help you. So looking at the situation nowadays related to COVID-19's outbreaks that cause a huge impact on the global economy, it requires both immediate and long-term actions. The key is to prepare for actions. This is the reason why this program was made to help the government so they can support startups to survive and thrive in this COVID situation. And this situation has also significantly changed the nature of startups funding. So startups must be able to adapt and adjust to their strategy to increase their chances to get funded. In this webinar session, we will learn what can be done as a founder to successfully get funding in the current pandemic and after pandemic. This webinar will also discuss the relevance of bootstrapping as a funding strategy. And I would like also thank all the partners, Seribu Startup Digital and Cominfo as a strategic partner, Kumpul as a committee partner, Zillion as media partner, and Salaksa as event partner. Our speakers today, I would like to introduce him by myself. Our speaker today has 12 plus years of business development, go-to-market, and venture capital experience for technology product. Previously, he ran an early-stage $25 million venture capital fund backed by several big companies like Cisco, Fidelity, Excel, the World Bank, and also Singapore government. He also served on company boards and been a CXO on demand to several portfolios company. So without further ado, please help me welcome our one and only Chirayu Wadke. Hi.
Thank you. Thanks for having me. I'm very good. Thank you so much. And thank you for everybody for making this happen. And for Hadi, who's on the call, thank you so much for having me also. Really appreciate the invite.
Yeah. So today we will talk a little bit about fundraising and bootstrapping and how founders can, adapt with this new normal. And then after that, we will see participants, they will also have questions for you to answer and help them. All right. So I have a list of questions here, but I would like to start with your view about how this pandemic affects fundraising activity, especially in Southeast Asia, Singapore, Indonesia, and other countries.
Yeah, I think firstly, I would like to say that, I just want to very sort of take a position that I don't think I have any of the answers, right? I probably, whatever I tell you, you should take with a pinch of salt and use it for the best you can, given the circumstances of your specific venture or company. Because honestly, I don't think anybody knows any of the answers. And therefore, my humble sort of request would be to take my advice, with some degree of, disclaimers, and hopefully, to your specific situation. But having said that, yes, we saw a few things happening when the pandemic started. Specifically, I'm relating to investments that I had made before when I was at C+, or even sort of I'm part of a sort of a angel investing club called XA Network, and we're seeing a lot of companies there. So across the board, I think a few things that we've seen is the pandemic. Nobody has any answers, right? So anybody making any forecasts around what's going to happen 3 months, 6 months, nobody knows. It's just sort of your best estimates of what might happen, and you keep sort of agile. Having said that, a few things we've seen. We've seen that later stage companies have been disproportionately affected in a manner that earlier stage companies would not have been. And there's a reason for that. later stage companies have a lot more revenue, and therefore if that revenue goes away, the cash gap just goes up. So suddenly now, if Series C company was had assumed that they would need 50 million, now suddenly they need 75, 80 million dollars. Now I don't think
Mm.
earlier stage companies have that same issue. They are actually much better because most of them did not have too much of revenue coming in. So for them, it's a very small adjustment from a cash flow perspective. So we think that early stage companies actually, if they play it well, they have a better chance of survival. So this was an insight that came through where we felt that from a cash flow perspective, earlier stage companies have been are better off. Having said that, there's a lot of fear in the investor ecosystem
Mm.
about the survival of certain businesses, and that's what we are seeing increasingly. So yeah, I mean, it's an environment where because people don't have the answers, they prefer to wait, if with the hope
Mm.
that the more time progresses, the more information they have, and the better answers they can get. So that's sort of why they continue to why we see the environment we are seeing, because nobody has any right answers right now.
All right. So, because investor start to, like maybe wait or very selective in giving a funding for startup, what do you think in view of investor, what kind of startups or traction or some factors that make investors still want to give a check to startup for
I
fundraising?
think, yeah, I think the fundamentals haven't changed, right? So if you have a product that is desired by many users, or by large customers who want
Mm.
to pay for the product and continue to use it, once or twice a day, and the numbers support that, and you have a good dedicated team that is keeping spend in control, and not spending on things that they shouldn't be spending on, or not becoming too ambitious where the cash is being spent on things that are not core to the business. I think as
Mm.
long as that is true, nothing really changes from a good investor's lens, right? There are a
Mm.
few industries that will obviously come under scrutiny, travel being one of them.
Mm.
We are seeing a little more discretion or diligence done by investors to before they invest in travel. There
Mm.
are others like food and beverage, where because of restaurants having limitations, there are a few people that are holding back on companies in that space. But even there, the fundamentals don't change. For example, Traveloka just raised $250
Yeah.
million, right? So within in a pandemic, to have raised $250 million tells you that if your company has value for customers, you will be able to find the right investors who will be ready to back you. So nothing's honestly changed. The only thing that they would look for is survival of the company through the pandemic. So instead of
Mm.
6 months of cash runway, or 12 months, you should now think of 24 months, 18 months, 24 months, right? Because you want to have enough runway to see yourself through this situation. So I would say only that has changed. I don't think the fundamentals have shifted as much.
Mm. Some industry that like have more impact in this pandemic is travel and F&B. And what is the industry that get impacted positively in this pandemic?
So I think there's a lot happening around healthcare, uh, because I
Healthcare.
think healthcare has definitely seen a positive trend, whether it was remote telemedicine or otherwise. I think healthcare definitely has seen a positive shift. In some cases, I think there are remote work. Companies that are supporting remote work are
Mm.
definitely seeing an uplift. I think these stand out for us as areas. Then everything around that makes e-commerce possible,
Mm.
because retail is going to be a tough sort of adjustment.
Mm.
Um, um, Physical retail, and therefore everything is going online. And to
Mm.
support online e-commerce, there are a bunch of activities happening, including logistics, including payments. There's managing the channels, for example, omni-channel marketing, it's social commerce, all that's getting a lot of interest because everything that replaces physical retail and takes it online is all seeing a lot of traction.
Mm. Yeah. Because I experienced it myself in Jakarta or big city in Indonesia during this pandemic. Like the number of my transaction in online e-commerce is increasing because I don't want to go to the physical store, right? So the online e-commerce during this pandemic, they increase their traction from the customers.
Yeah, and another one is education. I think a lot of
Ah,
education companies coming up. So I
yeah.
think people are increasingly sort of looking at not just education, which means replacement for schools, but also
Mm-hmm.
since everyone's home now, they're trying to upskill themselves. So you're seeing a lot more action on that front.
Yeah. Me myself is the founder of education technology company,
Yeah,
and
yeah.
I'm really
You should
happy
know
that
this better. Yeah.
yeah, in quarter two, I'm happy that one of big investors in Indonesia trusted us, believe in our vision, and uh, they give us fund for the seed round. Well,
Congratulations. Yeah.
but thank you. But besides of fundraising, or I mean, having money from investor, the other strategy for survival in this pandemic is doing bootstrap with managing cash flow and managing the operation costs. What do you think the advantage and weakness of bootstrapping as another funding strategy?
Bootstrapping is the best thing you can do to your business. It's the most a risk-free way of building a business.
Mm,
If I were to um, start a company today, I would spend the first 2 years just assuming that I will not have capital and
mm,
try to get to a point where I am cash flow neutral. And that's actually when I start building for growth. Until
mm,
then, I build for survival and I ensure that, uh, and this is nothing to do with the pandemic. The pandemic only accentuates the fact that I need to make sure I'm financially healthy. But I would completely sort of go on record and say uh, building via bootstrapping is the right way to build a business. Uh, Starting to take early investor money and relying on external financing as the only method is not the right way to build a business. It is
mm,
actually depending because it's not just money that you're bringing in, you're also giving away control of the company to someone else, control
mm,
of decision making, control of where the company should go. And once you are in that zone where you are taking external financing, that's, and then you're sort of put in a situation where you're forced to grow at a certain rate, you have to keep taking external financing. So it becomes a treadmill that you cannot walk away from. But if you were to grow through, you know, uh, I would say bootstrapping, it means a completely different thing. Having said that, there are some industries where bootstrapping may be tougher, right?
mm,
There are industries where you know that they're high growth and they're highly competitive. And if you don't have the money that other VC funded companies have, you may not stand a chance to compete.
mm,
And those you have to figure out for yourself whether you are in that vertical, right? If you're
mm,
not, I would say you should take a more classic approach to building, a more ordinary approach to building, which is to build bootstrapped companies that get to profitability or get to a cash neutral, and then you can go raise money. Uh, in Southeast Asia, in uh, APAC, uh, if you look back at history at 150 years of how people have made money,
mm,
venture capital is just 10 years old, right?
mm,
But if you look at the history of how money has been made, it's been made via profitability. It's been made
mm,
by making companies cash flow positive. And I think that art is not lost; it still exists. And I think just going back to that is incredibly powerful for founders because then you are, in some sense, responsible for your own destiny. It is
mm.
harder; it's a tougher, longer course, but it ensures that you are not subject to investor pressure.
Hmm. Do you have any example if you can share to us, like a startup that doing bootstrapping and succeed, and then at some level, finally they fundraise for the company?
Uh, yes, I mean, as a VC, it's hard for me to find good examples of that because, the companies that we pick are high growth and therefore, we
Mm.
tend to, but even within that, we want to look at companies that have ensured that they use capital very, very carefully, right? Where if you've gone to a certain number of users or revenue with half the capital, that's always a better company than someone who's got into that same revenue with more capital. So I'll give you an
Mm.
example, right? In my cohort, there's a company I was on the board of, and everyone would think that this is a high burn company. It's called Neuron Mobility. It's a scooter
Mm.
company, e-scooter company, and everyone associates it with massive burn that you would have spent millions and millions of dollars, right? The reality is the founders are very, very uh, careful with how they spend their money. So they actually have been able to get to a good, close to a $10 million run rate of revenue,
Mm.
uh, raising only about, $6 million, $6 to $8 million. And then they raised the balance, 15 million once they had that revenue. They launched in about 5 cities with very, very limited capital. And they did this because they knew uh, where they want to spend their money. They kept costs low. They built a very good team at low cost that was multi-location. It was not in Singapore alone. It was sort of across locations. Launched in cities that made sense from a business perspective for them, and they were able to do this in half or one third the capital of strong competitors, right, or even one fourth. And the
Mm.
reason I feel this is a good example is because the founder was not a first time founder. He had built a solar
Mm.
company before, and the solar company didn't have access to venture capital. So he was used to building business which was
From
cash flow
scratch.
based,
Uh-uh.
right? So he translated that experience into this place. And guess what? It was the right thing to do because now the company has, 40, 50 million in the bank account. And,
Wow.
they're so far ahead now of competition that relies heavily on venture capital and has no cash in the bank, right? And therefore, to be in that situation where you have 4 years of run rate,
Mm.
4 years of runway at COVID is an exceptional place to be.
Wow.
So it's possible, and obviously there's some luck involved, like everything in life. But I think importantly, keep costs low, stay judicious. Don't go open a downtown office. You don't need one as a company. You can have an office in areas that are not considered to be cool. That's
Mm.
fine. These are not places you want to spend on. You want to spend on the right things. You want to spend on
Yeah.
engineering talent. You want to spend on acquiring customers where it might be
Yeah.
useful to acquire customers, right? So just be careful on how you spend your money.
Mm. All right. Speaking of bootstrapping, I wonder the other type of having a fund for your startup, which is bank loans. It's something that as a founder we need to consider.
See, bank loans, the problem is that, banks are used to giving loans to a certain type of customers who they
Mm.
think are worthy of their credit, where they can get money back.
Mm.
And startups that go to them do not have the necessary records to get that
Asset.
money,
Mm.
right? And I don't think anybody can blame either the bank or the startup. The banks have reached the conclusion that these businesses can't be funded based on the history and experience they've had making such investments in the past, and knowing that
Mm.
when they have lent money they have lost money, and therefore they're careful in how they lend money. So I wouldn't write it off, but I would say that yes, if you have a cash flow business, if you have business where you have customers who are paying you money for a certain amount of time, and you don't need too much money, you need 50, 100K, letter of credits or line of credits or bank or financial institutional funding that is debt oriented is a
Mm.
much better place than equity. Equity is the most, it should be the last option for founders. You should not be giving out equity if you have access to other forms of
Option.
financing at reasonable price. Now, if someone says to you, 24% interest, obviously that's problematic, right? But if someone says I'll give it to you at 7-8% interest or 10% interest, I would consider it, because that's, if I can service that loan, I'm in a much better spot than trying to go after venture financing, right? So I think that's what I would say. And even within venture financing, there's a lot of action is seen on uh, VC funding for equity, but there's a whole business or a whole industry around debt financing in venture, where VC funds focus on debt financing for large startups or growing companies. So I think we should never look away from debt financing. It's definitely a huge deal, especially for capex expenditure. If you have any capex related to hardware or any of the stuff that can be financed, I would just go down the financing route. For example, you might be using some vehicles for your business, so you might be using things that are classic sort of asset financing that the banks understand, and you should go to banks for that, and they will finance it because there's a collateral against it. So totally, I mean, I think I fully believe in that model. It is an untapped source of financing that should be taken advantage of.
All right, so we have several questions from the participants. Maybe I'll try to. All right. Someone asks, how do you build relationships with investors during this difficult time?
So, investors are interesting, people. They, if you ask them for advice, they give you money. If you ask them for money, they give you advice, right? That's the saying.
Oh my God.
But I think if you have to build relationship, I would say get an intro through someone who knows the investor ideally, and start there, and then don't just keep the investor abreast of your company. Say, hey, here's what I'm building, and this is the product, and just leave it at that. I think most investors who invest in companies have built a relationship with the entrepreneur over a 3 to 6 month period before they invest. Those are the best investments, because it gives a chance to the company to learn from the investor and understand if this investor is the right person to work with them. And the investors get a chance to see if this founder is someone they want to work with. Because regardless of how you may hear this, that investors pick their founders, the reality is it's a two-way street. Founders need to also, be comfortable with the investor, because it's like a marriage, right? It's a 5 to 8 year journey. You would know that. It's a 5 to 8 year entrepreneur journey. Anyone tells you it's less than 8 years is kidding. That you're going to get anywhere with your company before 5 to 8 years, right? 8 years is what we think is the right period. Even 10 sometimes, right? That's really, you lose a decade. And if you're going to spend a decade of your life, that's on an average 1/7, 1/8 of given average life expectancy is 80 years, right? And in your productive capacity, 40 years or 10 are spent on a company, that's 25%, right? So if you're going to spend 25% of your working life on one company or on a venture, or even half that, 12 and a half, 15% of the company of your time, you better get the investors right. You better understand whether these people are the right ones for you and go with you for the journey, right? And if not, then you should never hurry into taking money, because yes, unless you're compelled to, and there's no other option, and sometimes competitive pressures cause you to. But to the extent you can be in control of the timeline, do that, because this is the most important and one-way decision you will make. It's a one-way door. Once someone cuts you a check, that's it. They are your investors, and you can't reverse that, right? So be very careful on who you allow into your company as the investor. So, and for investors, they want to make sure that when they invest, it's a one-way street. Once they invest, they are with the company, good or bad or ugly, doesn't matter, right? Outcome wise, they're with the company. So So yeah, I feel that's how you build relationship. It's over a long period of time.
Mm. All right.
I wouldn't, for example, I cannot start um, expect a decision from an investor if I get to know them 15, 20 days before. It might happen. Okay, it happens all the time. Yes, demo days, and suddenly 100 investors show up at Y Combinator. But if not, if you're the ordinary person who's not in Y Combinator,
Mm.
build your relationships with investors starting today, so that 6 months
Mm.
out when you need the money, they already know what you're building.
Mm. So it's a long-term relationship, right?
Yes,
Yeah.
long-term relationship.
All right. The next question: how to build partner trust in companies that do not survive due to the pandemic? Is it necessary to open a company with a new name? Do you get the question?
No,
How
I
to
can you say it again?
how to build partner trust in companies that do not survive due to the pandemic? Is it necessary to open a, maybe it's two questions.
Two quick.
The first question is how to build partner trust in companies that do not survive due to the pandemic.
Okay. So I think the question is, probably I'll rephrase it, is given the pandemic, partners feel companies will go out of business, and therefore, how to get partners to trust your company. I guess that's
Mm-hmm.
what it is, right?
Yeah.
Yeah, I think this is a tough one. I think we're seeing it all over the place, right? Because big companies are also having a hard time. So, small companies getting the partner to trust small companies is tough. In this case, I think it really boils down to a people to people relationship. I think the
Mm.
founder or the CEO needs to step up and be the person that creates that trust, and being very transparent and open about the situation and saying, here's how why we think we will survive. And part of it is data based. You have certain financing.
Mm.
You may not have the best of financial health, but you as a founder can go there and say, look, it doesn't matter how well my financial health is today. I'm going to build this for the next 10 years, and this is my commitment to you. Usually people buy that. They see the commitment, and they feel, today financial health may not be great, but if the founder is standing up and saying, this is pretty much what I want to do for the next 5 years, um, at the very least, that there's a person there who you can trust and who will at least keep their word, regardless of how other things might pan out. The other thing that helps is just validation. So to say that, look, I have backing from investor 1, 2, 3 obviously helps. Also to say other customers like ABC, XYZ are you know are relying on me, and therefore I'm not going anywhere. To say that large banks are my customers, large airlines are my customers, large telcos are my customers. If you have any brands that you can speak of, it creates that positive sort of reinforcement that you're not a fly by night operator, right? Or will just shut down the next day. I think number of employees also helps. To say I have 50 employees, 100 employees, whatever the number may be, 10 employees. It's the number does matter. If you tell them you have a certain set of employees, they understand you're a going concern, and you're unlikely to sort of wind up suddenly because of a financial situation. Again, having
Mm.
said that, it might happen, but the chances are lesser. So being open about your company's existence, when you started, and just walking partners through that history, I think creates that level of trust that's needed.
Mm. So trust is something that really important in business, right?
Yeah.
Yeah, with investor partners, everyone, all stakeholders in our business, we need to build trust with them.
Even employees.
Yeah.
Even
um,
employees. Yeah.
I have good question in here. From investor perspective, sectors that are growing so fast during pandemic, will they keep growing after pandemic, or the trend will be back to normal before pandemic? For example, healthcare.
Um, it's hard to say, right? I mean, I'm not an expert and I can't predict. So I say that I don't know, but we can make some assumptions about the fact that after the pandemic, a few things will happen. I think all governments will want to make sure that they never have another pandemic. So there'll be a lot of infrastructure investments, system investments into
Mm.
ensuring to prevent a pandemic, or to
Yeah.
respond to a pandemic, right? For example, Singapore did it in 2003-4, where they had SARS and they reacted and they created a system, and I think it helped them to some degree. Right now, I would say that this pandemic was far worse, but I think the learnings from this will be applied again in, say, 15, 20 years when we might have another one, right? So I think for sure healthcare will continue to get the attention now that for the next 5, 7 years, because uh, people want to learn from this, right? And they will make sure that uh, uh, from other infrastructure like remote work, I'm less bullish. I feel remote work is more fad right now. People are talking about it. Yes, some changes will happen. Remote work has created a lot more products, a lot more services, and it has created a lot of cultural acceptance of being remote. But I think it's a little overdone. I think my personal opinion is that, and may not be how the market plays out, is that if people are able to work together face to face, they will try to work together face to face. It's just how humans are, and we will come back together.
Yeah,
We will,
yeah.
but the percentage of remote work will go up. It won't go down. So it
Yeah,
was say
yeah.
10-15%, now it will be at 30-40%, right? So for sure. And I think that'll impact the labor market, because I think what will happen is, work will change in terms of definition. It won't be local, it will be international. So I sitting here could be doing work in Europe, could be doing work in the US, right? And I get paid here. It was happening in many situations. Now it will just become very common. And I don't know if there's a reversal from that, because if I can get something done at 1/5 the price in the US of the US, people are going to take advantage of it. Whether it's something that will continue and will see uh, sustenance is a huge question mark, and I don't know what the answer to that is.
All right, all right. And there's also questions. If as an investor, if your portfolio doesn't perform well during the pandemic, would you inject money to them for survive, or let them decide to close their business?
It's a tough one. I think you do that. It's more dependent on the situation, right? It's not that simple that whether it's a survival question, right? I think it is important to understand what the pandemic has done to their business. Whether the pandemic has affected it in a way where it won't ever recover, right? For the next year and a half, or has it affected their business in such a way that they can pivot to something else, um, right? I think the facts matter, whether it's possible to change the product to target another market if the original market and thesis doesn't work. So it's a little more complex than that. In some cases, we have also said, for example, if it's a travel startup, just shut down and go back and come back after 18 months, right? Don't do anything. Pay your employees the bare minimum they need to be paid, so that you're not firing them, you're keeping them employed. But the moment you think things have started to look up, get back in, right? We've given that advice, we've given that pragmatic advice to people. But the question of whether uh, we invest in companies, I think it really boils down to the specific situation. Because at the early stage, what you're really betting on is two or three things. One is the quality of the management team, and two is the market that they're going after. And these are two basic things. And um, if the market has changed, but you believe that your founders are capable of negotiating that change in the market, then you continue to invest in the company. If you believe that the market's changed, but the founders will find it very tough to change their product in a time frame that makes sense, and in the money that they have, then maybe the right decision is to not continue, right? But it really depends. It's not something that can be sort of
General.
put on a piece of paper. You need to look at the specific situation.
Yeah.
um, are there outstanding contracts? Are they kind of getting revenue already in which case, can they sort of reduce their expenditure and be self-sustaining, and does that give them more time? And therefore, time means that they can change direction.
All right. Agree. So the participants in here, some of them are founders, but some of them
Yeah,
are someone who want to build a business, right? So there's a question: if I'm not have a business right now, is it the right time to build a business, or should I wait until the pandemic is over?
there's no good or bad time to start a business. Every day is a good time. So don't wait for the pandemic to get over and then hope that things, because see, at the end of the day, entrepreneurs will find opportunity in whatever situation they're put into. In fact, the harder the situation, the more opportunity there will be for things to, if there is more chaos, there's more opportunity. If it's normal, then there's normal situation, there's not as much opportunity. So I think my answer is, if you're waiting for the pandemic to get over, I think that's the wrong event you're waiting for. I think if you want to start a business, start a business. Go out and get started, right? It's as simple as that.
All right. And any tips on approaching venture capital or investor for fundraising during the pandemic? Or is just the same with normal?
No, there's no change. I think there might be some form factor change. They'll want to do video calls and stuff, and therefore, it's important. It's an important distinction, because I feel that video calls are not sufficient as a mechanism to get comfortable with people. I do believe that face to face is still the best way. We get to sort of size up each other, get to know each other. Body language plays a huge decision in becoming comfortable with each other. And if it's a long-term journey, it does matter, right? Now that's changed, and therefore, I would say that from a perspective of positioning your company, I would say just make sure you give investors comfort that it's, as I said, it's not a 6 to 8 month kind of runway. You're looking at a greater runway um, on an average. I mean, there might be companies that outperform, and even if you have 6 months, they might say, "Oh, we perform really well, and you're not able to attract investors and do well." But that's more the exception than the rule. And I would suggest that when you think of raising money in this environment, think of 18 months as sort of the minimum amount of money that you need to be able to give investors the confidence that if they invest in you, you're still around after 18 months, right? And you're not going to be, you're not folding up before that, because you have the cash runway.
Yeah. Why 18 months? Do you have any formula on that?
No, I think the general belief is that by the end of 2021, that the pandemic should come to a close. At least that's what the general consensus is. And therefore, to give yourself enough allowance, I'm adding maybe a few months to that, and saying give yourself 18 months to be completely out of the pandemic, right? So you don't need to go out and invest, look for investors in the middle of this situation. So say you raise money today and you have 18 months. Just gives you enough time, right? And you don't need to go back out when the situation is not great, when demand is short, and therefore your numbers may not be what investors find attractive to invest. So you will go through greater dilution to raise that money. So all that adds up. So if you can take 18 months of runway now, it just puts you beyond. Goal number one is, there's only one goal for any startup, right, or any company: do not run out of money, right? Period. Like, that's the only reality. So you just need to watch for that. And therefore, I'm saying 18 months, because if you have money for 18 months, you have to put yourself beyond defeat. And the only way you're defeated is when you don't have money, right? Because then you can't do anything. But if you have money, whether it's self-financed, bootstrapped, or otherwise, you can live for another day. So that's what I would urge people to think about, right?
What is investors' perspective on company valuation or company profit? Which one investors more interest in?
It's a very broad question. I think it depends, right? It depends on the segment. It depends on the stage of the company. If I ask someone to be profitable in the first year, am I measuring the right metrics? If I'm asking someone to be, someone to be cash flow positive in 3 months, am I asking the right questions? I think these are difficult to answer questions, but the reality is that uh, it depends on the segment, and certain investors will prefer to provide higher valuation for the founders that they find comfortable sort of putting their money into. And therefore, you can't create rules whether there are any sort of methods to this. It really depends on the industry and the founders that you're backing. And if you think that they can build a large business that's say $200-300 million business, then you might say overlook the initial profitability and say, look, they're going to build a big business, right? And see, valuation profitability ideally should be tied, but the reality is even in public markets today, those two are not tied, right? If you look at what's happening on Wall Street or Nasdaq, the profitability of a company and the valuation that it gets are completely unrelated, right? So I think the same thing reflects in the private market where investors are investing in companies that may not have the profitability, but they're investing because of future profitability or future growth. So that will keep happening. So there's no such rules as such. I think it really depends on the segment that you're thinking about.
All right. There's one question, but I think we already covered it. What do investors? Yeah, but maybe if you have like add on to this question, what do investors look for in companies during this COVID period?
Yeah, I don't think they look for anything different. I think the only thing they would look for is whether the business in the next 6 to 12 months will be able to generate the amount of sales or amount of business or amount of usage that is reflective of the company's future prospects, and whether the money that they're requesting is tied to that, right? And I think that's all they care about. If I'm making an investment today, during the course of my investment, which is typically 1.5 to 2 years, it may actually be that and that's how I think about it. It's not rocket science.
All right. And Hadi Osman, he asked, Chirayu, if you don't mind, can you give examples of companies that are thriving right now during the pandemic that might not thrive after? Oops.
No, I mean, I don't want to take names because I don't think I want to be in a situation where I forecast a company not doing well. Type of companies is fair, Hari. I'll try to answer that. So I think, as I said, I do believe that remote work is a little overhyped. I think they're thriving and they're attracting a lot of capital because people believe that the trend is secular and it is unlikely to change, that it's going only in one direction. I think that's one. And that definitely I feel is misplaced. The other thing, definitely, there's going to be a lot of overinvestment in online education. I'm not saying that online education is good or bad. It's just that there's going to be overinvestment, and a lot of companies that get the money right now, once the pandemic kind of restores, our allocation of time to these activities will change. It's not like things are changing; it's the behavior of people, right? We have a lot of extra time because we are not doing any travel. We are not going to different places. So now we want to channel that extra travel into education, and for kids as well as for ourselves. And we can't be in schools. So, but a lot of the time allocation will shift back to normal. And therefore, yes, there'll be a few, companies that will continue to enjoy the behavioral change that happened as a result of this pandemic. But I feel it's overdone. These two, I definitely think trends are, and I'll put myself out there and say remote work for sure, I think is a little more challenged in my opinion than people like to believe. I think people are painting a completely extreme picture of remote work, and I don't think that's the right thing to do. I think life will happen in between those extremes. It'll be a little more middle of the spectrum, in my opinion. Does that answer your question, Hadi?
Maybe Hadi can. Yes, thanks. Yeah. Oh, he said just the type of companies, but you already told earlier, yeah? There's a question: do we need co-founders or a team before do fundraising?
No, I mean, some of the founders that you know of have been solo founders. So you don't need a team. What you need is you need to create. Yeah, it really depends on. One thing for sure, you can't build a business alone. You need a team. Now, whether those are co-founders, whether they're employees, is a choice you make. Whether you want them to go with the ride, go on the ride with you, and you know, be your partners. It depends. We obviously think there are advantages to having co-founders. You know, you have someone to share your pressure with, share your stories with. It always relieves the pressure because you're not doing everything. But again, it also could be that, you know, you're the kind of person that doesn't want to share the company with anybody. You want to run the company the way you want to, and therefore you may not be a candidate for. So yeah, there are no rules. I mean, you can do whatever you want. It's your company. It's your expression of your, you know, your creativity. So if it means that there's nobody else for the ride with you, so be it, right? In
But
fact, a lot of the business people, you know, smaller businessmen are solo, right? They are they call it sole proprietorship, and I think you know, across the world, that's probably the biggest you know, form of entrepreneurship. Yeah, startups are not known for that, but yeah, I think no team, you should just go start.
But in investor perspective, do they look at it as a minus, or doesn't matter at all?
It doesn't matter at all. See, the only thing that matters is what have you been able to achieve, because a customer doesn't care, right? Whether it's a B2C or B2B startup, a customer doesn't care, you know, what's my age, my gender, my skin tone, my what language I speak. As long as as a customer, I'm using the product and I love it, it doesn't matter, right? So if your customers are happy, whether you've done it alone with a team, you've done it alone with a co-founder, whether you've done it with, you know, with nobody else, just you, doesn't matter, right? The one thing though is being able to attract people early in your business as employees or as co-founder demonstrates your ability to convince people about your vision and idea, right? Because you're able to, at the end of the day, you are able to convince them to come with you. And that is a big signal to investors, because they're like, if I put money in this guy or this person or this lady, I know that that person will be able to go out and attract talent, because if I'm able to sell it to people who, you know, who believe in me without me having even a product, then I have the ability to sell it to investors, to sell it to future employees, to sell it to customers. So, you know, it demonstrates a certain amount of, you know, salesmanship that is needed as part of being a founder. A founder is all about, you know, being able to articulate a vision and hiring the right people to execute it. But having said that, many people have done it alone. So, you know, there are no hard and fast rules. It's just that if you're able to get people along the journey, it'll demonstrate to investors that you can convince others to join you, which is a big thing in any sort of situation.
All right. Do you think to get a fund, a business should run first, or it's just an idea and it's okay to do the fundraising?
The only people who have gotten money on an idea are the ones who have probably sold a company before. So I would say that for most other people who have not been entrepreneurs and sold companies, yes, you have to go through the process of building a company.
To get some traction first, yeah?
You need to build a business. Once the business is built and you have something to show, is when you can come to investors.
All right. But there's also some programs that you know, give funding to funders with idea. What do you think of it?
No, excellent. I mean, those programs should exist. There's no question about it. I think there are a lot of programs that put two people in a room, probably a PhD and an engineer, and they build something and they give them money, and that's great. But you know, most people don't have access to those programs. If you have access, great. You should take advantage of that. But you're giving away 10% of your company for that. Remember. So you should be ready to give 10% of your company. And it's a big deal, I think, how important you think that 10% is. But these programs are not free. They might sound free from a cash perspective because, there's no cash going out of your pocket, but, you're giving away 10% of your company. So it's really a balance, right? What you want to do.
Yeah.
And some of them are helpful, no question.
Yeah.
Uh, but their purpose is different. If I look at it from a pure play financial investor standpoint, my purpose is to make an investment in a company, in a founder, and get rewarded for taking that risk, and then get my money back with a certain percentage attached to it for growth. And if that is my mindset, I will always look at what is in the business. Now, in some situations, I may know a founder for 2 or 3 or 5 years. It could be my friend, it could be someone else I know I've worked with. In which case, I'm not betting on the business, I'm betting on the founder. In which case, the founder can get money from me without having a product. But that is because that I trust them that, the money I give them, they're going to take care of it and they'll put it to use. And if they don't, they'll give it back to me, right? Or they'll give some part of it back to me if they fail, which is okay with most investors when they invest that early. But again, it really depends, right? If you know someone who is willing to back you with a little bit of money, those are the best people to go to.
Yeah.
But most proper investors will look for some business.
All right. There's a case from one of the participants. My startup valuation may change during this pandemic. How to calculate rough valuation for my startup? Maybe the formula?
No, there's no formula, because in early stage, the valuation formula is simple. It's, post money, there's new money that comes in. Sorry, pre-money, new money that comes in, and you get a post money, right? So you have pre-money valuation, say $5 million, you bring in $1 million, your money company is worth 5 + 1, 6 million. How does that 5 million pre-money come about? It's a negotiation. There is no formula. It is really up to the investor how much the investor is willing to pay for that company, how many other investors are paying the same amount of money to get into that company, or more money to get into that company. That's about how much it is. Sometimes there's a more reasonable way of doing this, is to say, the founder should not dilute more than, say, 10, 15, 20%. And say, therefore, if that's the case, then, a $1 million investment should therefore be a pre-money of 4, post-money of 5, diluted 20% of the founder's equity in the company. And I think that's something that people good investors always look at, because good investors will not want their founders to be diluted as much, because it's not in the interest of the investor. I'm not going to come and run your company. And if I am, then I'm I'm not an investor, I'm an operator, in which case, there's a different problem you're facing. Then your investor is not really an investor. But if I believe in the founder, then the founder should be running the company and not thinking about dilution, should own enough and feel ownership. So I will make sure that the founder is not diluted, right? Within reason. So that's the other way of looking at it, but there's no formula as such. Yes, the pandemic has affected companies' valuations. They've come down. And the reason is the amount of capital that was available before the pandemic has changed in the market. Now you don't have as much capital. So you don't have capital chasing as many companies as it was happening before. Before, there was a lot of capital available, and therefore the valuation of companies went up. Right now, capital has come down. People said they don't want to invest in venture in Southeast Asia. They don't want to put their money in startups. They want to put their money in bank accounts and FDs, and they're growing scared. They're becoming scared, right? In which case, there's nothing to be said. It's just a question of a situation where valuation will come down. How much really depends on the industry that you are in. It depends on what your negotiating leverage is versus how many investors are trying to invest in you. So it's a whole bunch of things, right? Because if someone's ready to invest in you at a high valuation even now, and high can be anything from 5 to 10 million, 15 million. It depends on the situation. They are ready to invest that valuation. So that is the valuation. It doesn't matter what anyone else thinks, right? And therefore, I feel early stage is a complete, there's no science behind it. It's a negotiating leverage game, right? And you want to make sure that you don't dilute more than a certain percentage. In some cases, there are benchmarks set by competitors, where competitors have raised at a certain amount, and you look at that and, you say, okay, maybe I should be in that range, which is fair. But, again, if you're in Southeast Asia, you can't compare yourself to the US because those are unfair comparisons. The market size of US is 10 times Southeast Asia. So your startup doesn't have access to that market. So your company may not be worth as much, right? So I think comparing it to, companies that are in the same segment, in the same market might be a better place to start. But again, I mean, it really depends. It's not a science.
All right. There's a question again. Actually, what really investors look for beside money or profitable? As we know, a lot of startups do burn their money strategy, burning money strategy.
It's just team. I think team and market size. I think these are two big things. And then there is what are they building, the product and the business. But really, it boils down to team and market size. If we were to look at what carries through a company, it's the quality of the management, and it is the market they are going after. These are the two things. Now, the market also can change. If they pivot and decide to go after another market, that can change. But only a quality management team can pivot a company dramatically in the middle of a pandemic. So if you've not, if the investors have not identified a quality management team to invest in, then it's tough. So that's baseline, and then the market size that determines the outcome. Sometimes the structure of the market is so good that even if the management team is mediocre, you can get amazing outcomes. So I would say that it's not profitability. It's the quality of the team. And the quality of the team, I mean, being able to learn very quickly from mistakes is the number one criteria. To be able to listen and pick up on, I did something here and I think, I shouldn't repeat it, or being able to sort of quickly change direction, quickly learn from mistakes is the critical skill to that most investors would look for. Learning agility is what they call it, to learn very, very quickly.
Is it applied sorry?
Go ahead.
Is it applied to early stage startup or for any level of startups?
Anything. It's.
I mean, like later stage startup, maybe investors looking for profit as well, right? At the end.
Yeah, I mean that obviously does matter, but what investors will always tell you is the quality of the management will be overweight in most situations. As you kind of go towards later stages, you get more data about the company, and therefore the data will tell you whether the management is quality or not. Right? Now, if the management is quality, you will see positive results. You will see data supporting those theses. In the early stage, you don't know, right? You don't know whether a company, management is quality or not, because quality management will lead to good financial outcomes, whether it's Series B, C, D. You will have the data to prove that this is a quality management setup, because they would have every answer to any question that you ask them. They will know their business better than you. They would tell you why certain things are the way they are, right? But at the earlier stage, it's tougher because they are still building out their business. There are no data points that they can show you, but what they can tell you is the process and the mindset that they bring to the table in terms of approaching how they're solving the problem, and that to investors is more important than not just numbers, right? Sometimes they have the numbers, but they don't know why customers are buying their product. Which to me is problematic, because which means you've arrived at the answer through luck and trial and error, and you don't know why some things are happening, which means if things go wrong, you won't know why they went wrong either. So, is that the investor? Is that the company I want to invest in? Possibly not. So, even if the results are not there initially, I think having the ability to, explain what's going on in the market, and tie the product performance to market conditions and be able to explain the business in its details is what differentiates a good entrepreneur, a good founder from a not so good one.
Okay, so this is the last question since the time is already
no worries.
Is there any shift? Is there a shift in mindset from building a startup, meaning hyper growth, to building a business, meaning profitable, in this during the pandemic, or like in 1 or 2 years?
Yeah, I think for sure there is, and I think that's happened because I think people had assumed hyper growth is the only way to build companies, and I think that's gone away. People will go back to basics a bit, hopefully, and we'll be back to building companies the old-fashioned way, hopefully, because I think that's the right way to build companies. I think hyper growth is great, but it works in some situations where the market size is large and you are building a business that's got a high gross margin. I think those are situations where hyper growth really works and helps you build out massive companies. I think if those conditions are generally not met, it's very difficult to build out hyper growth stories. Yes, you can build the odd like money losing hyper growth story, but at the end of the day, if it's not going to turn profitable, then you have lots and lots of examples of large companies that are constantly burning money, right? And really have no path to profitability. And I think that's hitting the market now, and that's having an impact on early stage where VCs and investors are now saying, you know what, even if you're not profitable today, we want to see a path to profitability. So yes, hyper growth is great, but also have that story of monetization and unit economics tied to it. So yes, it's definitely shifted.
How long is the path to profitability that an investor look at? Like 5 years, 10 years, or more?
No, I think it used to be longer back, but now I think it's contracted. I think it's hard to say what numbers, but it's definitely not what it used to be. So if I don't know what it used to be, it probably was like 3 or 4 years or 5 years, but I think it's come much shorter, right? I think now people want to ensure that there's some semblance of profitability by at least by Series B, right? That you're hitting profitability by Series B.
Oh, all right. So,
well, at least like unit economic for positive by Series B.
Do you mean like in Series B or when you want to fundraise for Series B?
No, past Series B. So once you've raised Series B, you should be getting to some degree, which is even hard, even now. So, people like to push it to Series C and D, but I feel like it'll start, mattering whether you are even going towards a reduction in gross margin. Sorry, a reduction in the loss you're making, right? Per unit of whatever you're selling. So I think that'll start to matter, that you kind of get better and better at, not spending as much money as you were before and delivering the product at a much lower cost as you progress.
All right. All right. Do you have last words or tips for all the participants?
No, thank you. And all I would say is just don't let the pandemic get to you. I mean, there's businesses will be built even in this time frame, and you will hear a lot of stories of companies that started today or this time frame that did really well. So don't let it get to you. In fact, the more there's chaos, the more opportunity, and you should look at it positively and see if you can build something useful.
All right. Thank you so much, Chirayu, for your explanation. I believe it will help us a lot as a founder or any businessman.
Thank you so much. Thank you for having me.
All right. I think we're done here today. Once again, thank you so much, Chirayu, for your time. And thank you also for all the participants that all already joining this session. I hope you to stay safe and see you around. Bye-bye.